Chapter 6. Reporting and interpreting sales revenue, receivables, and cash. The revenue principle requires that revenues be recorded when earned. Revenues are considered to be earned when three conditions are met. 1. Goods have been delivered or services have been rendered. 2. The price for the goods or services is known. 3. Collection from the customer is reasonably assured. Part 1. Companies accept credit cards for several reasons: to increase sales, to avoid providing credit directly to customers, to avoid losses due to bad checks, to avoid losses due to fraudulent credit card sales, to receive payment quicker. Part 2. When credit card sales are made, the company must pay the credit card company a fee for services provided by the credit card company. The fee is typically between 2 and 4% of the amount charged by the customer using a credit card. Part 1. Customers purchasing on an open account are usually offered a sales discount to encourage early payment. The sales discount terms are typically written as this slide shows. This particular discount term would be read as 210 net 30. Part 2. The first number represents the discount percentage, 2%. The second number represents the discount period, 10 days. The letter N stands for the word net, the invoice amount. The last number represents the entire credit period. In this case, if the customer pays within 10 days, then a 2% discount may be deducted from the invoice amount. If not, then the full invoice amount is due within 30 days. With discount terms of 210 net 30, a customer saves $2 on a $100 purchase by paying by the 10th day instead of the 30th day. If not paid until the 30th day, the customer has incurred $2 of interest on a $98 debt for 20 days. The annualized interest rate for the decision to defer payment for 20 days is 37.23%. Even if the customer had to borrow money at 12 or 15% interest to be able to pay in time to take the discount, the money should be borrowed to avoid paying 37% interest. Customers may return undamaged merchandise for a full refund. This is called a sales return. Customers may also return merchandise that is damaged but usable. In this case, the seller may offer the customer a reduction from the original selling price to entice the customer to keep the damaged merchandise. This is called a sales allowance. For either type of return, the seller debits sales returns and allowances, which is a contra revenue account. Companies record credit card discounts, sales discounts, and sales returns and allowances separately to allow management to monitor these transactions. Credit card discounts, sales discounts, and sales returns and allowances are contra revenue accounts deducted from sales revenue in the income statement to arrive at net sales. We will discuss each of these contra revenue accounts in the following slides. Part 1. The difference between sales revenue and cost of goods sold is called gross profit. The gross profit percentage indicates how much of each sales dollar is left after deducting the cost of goods sold to cover expenses and provide a profit. It is calculated as gross profit divided by net sales. Other things being equal, the company with the higher gross profit percentage is pricing its products higher. Part 2. In 2006, Deckers reported gross profit of $141,199,000 on sales of $304,423,000. Let's calculate Deckers' gross profit percentage. Deckers' 2006 gross profit percentage is 46.4%, obtained by dividing gross profit of $141,399,000 by net sales of $304,423,000. Notice that Deckers' 2006 gross profit percentage is higher than one of its competitors and lower than another competitor. Part 1. When companies allow customers to purchase merchandise on an open account, the customer promises to pay the company in the future for the purchase. In most cases, the customer is offered a small discount to pay cash within a short period after the sale. Part 2. Accounts receivable are amounts owed to the business on open accounts. There are two types of receivables. 1. Trade receivables are amounts owed to the business for credit sales of goods or services. 2. Non-trade receivables are amounts owed to the business for other than business transactions. For example, personal loans to employees are non-trade receivables. Part 1. Businesses extend credit to customers to stimulate sales, but credit sales are not without costs. Some customers may be unwilling or unable to pay off their accounts receivable. Bad debts result from credit customers who will not pay the amount they owe, regardless of collection efforts. Companies must account for the fact that these customers may not be able to pay the amounts they owe. We will focus on the allowance method of accounting for bad debts. Part 2. The allowance method attempts to match bad debts expense in the period with the related revenue. This method has two advantages. 1. It adheres to the matching principle because the bad debts expense is recorded in the period of the sale. And 2. It reports accounts receivable on the balance sheet at the estimated amount of cash to be collected. Part 3. Since the actual amount of bad debts may not be known with certainty at the end of an accounting period, businesses record an estimate of the bad debt expense with an adjusting entry. Let's look at an example. Part 1. To illustrate the adjusting entry, we will look at an example from Deckers Outdoor Corporation. Deckers estimated bad debt expense for 2006 to be $4,685,000. Let's prepare the adjusting entry. Part 2. Deckers debits bad debt expense and credits allowance for doubtful accounts for $4,685,000. Bad debt expense is normally classified as a selling expense on the income statement. Allowance for doubtful accounts is a contra asset account that is deducted from accounts receivable on the balance sheet. Because we do not want to overstate assets, we must show accounts receivable at its net realizable value on the balance sheet. Net realizable value is the amount of accounts receivable that we actually think we will collect. The allowance for doubtful accounts is subtracted from the accounts receivable balance. The reported value is called net accounts receivable. Part 1. Now, let's see what happens when we determine that a specific customer will not be able to pay the amount owed. When it is clear that a specific customer's account receivable will be uncollectible, the amount should be removed from accounts receivable and charged to allowance for doubtful accounts. Part 2. In 2006, Deckers determined that customers with balances totaling $6,969,000 would not pay. We will make one summary entry for all of these customers. Part 3. When using the allowance method, we write off the specific uncollectible accounts to allowance for doubtful accounts by debiting allowance for doubtful accounts and crediting accounts receivable for $6,969,000. There is no additional entry to recognize bad debts. We previously recognized bad debts expense when we made the end-of-period bad debts expense adjusting entry. Part 1. Now, assume that before the write-off entry, the balance in accounts receivable was $62,640,000, and that the balance in allowance for doubtful accounts was $13,069,000. Let's see what effect the write-off had on these accounts. Part 2. After the $6,969,000 write-off, the accounts receivable balance is reduced from $62,640,000 to $55,671,000, and the allowance for doubtful accounts balance is reduced from $13,069,000 to $6,100,000. However, note that net accounts receivable, the amount Deckers expects to collect, is unchanged at $49,571,000. The total write-offs of $6,969,000 did not change net accounts receivable, nor did it affect any income statement accounts. Part 1. Using the percentage of credit sales method, a bad debt percentage is based on records of actual uncollectible accounts from prior year's credit sales. The focus is on determining the amount to record on the income statement as bad debt expense. Part 2. When using the percentage of credit sales method, the bad debt expense estimate at the end of the period is determined by multiplying current period credit sales by an established bad debt loss rate percentage. The bad debt loss rate percentage is determined based on past history of the company and current economic trends. Let's look at an example from a company called Kids Clothes. Part 1. In the current year, Kids Clothes had credit sales of $600,000. Past experience indicates that bad debts are 1% of sales. Compute the bad debts expense for the year before advancing. Part 2. Bad debts expense of $6,000 is found by multiplying $600,000 times 1%. Now, let's prepare the journal entry to record the bad debts expense estimate. Part 3. Kids Clothes will debit bad debts expense and credit allowance for doubtful accounts for $6,000. When using the aging of accounts receivable method to arrive at an estimate of bad debt expense, the focus is on determining the desired balance in allowance for doubtful accounts on the balance sheet. First, we classify accounts receivable by age. Second, for each age group, we determine the likelihood of the accounts being uncollectible. Third, for each age group, we calculate a separate allowance amount. Then, we add up all the allowance amounts, and that gives us the desired balance in the allowance for doubtful accounts. The following slide shows us what an aging schedule for kids' clothes might look like. First, we decide on the aging categories for the individual accounts receivable from 0 to 30 days from the date of sale to over 90 days from the date of sale. Then, we list individual accounts receivable from kids' clothes alphabetically with the dollar amounts in each age category. Then, we total the amounts in each age category column. Next, based on past experience, we will estimate the percentage of uncollectible accounts in each time category. For the 0 to 30 days age group, not yet due, 1% is expected to be uncollectible. For the 30 to 60 days age group, 4% is expected to be uncollectible, and so on. Notice that the older the age group, the higher the uncollectible percentage. After determining the percentages for each age group, we will multiply these percentages by the appropriate column totals. Part 1. After we multiply the balance of each age group by its uncollectible percentage, we add the amounts for each age category column to get the total estimated uncollectible amount of $1,201. This is the balance we want in allowance for doubtful accounts. Part 2. Now, let's record the year-end adjusting entry for bad debts expense, assuming that the allowance for doubtful accounts currently has a $50 credit balance. Since we want the credit balance in allowance for doubtful accounts to be $1,201, and the account currently has a credit balance of $50, we only need to credit this account for $1,151. The adjusting entry requires a debit to bad debt expense and a credit to allowance for doubtful accounts for $1,151. The next slide will show us the allowance for doubtful accounts after posting the adjusting entry. The beginning balance in the account was $50. This is the amount remaining in the account at the end of the year after write-offs of specific accounts, but before the year-end bad debts adjusting entry. The adjusting entry for $1,151 brings the account to the desired balance of $1,201, the amount we determined from our aging schedule. Part 1. Here's a summary of the aging of accounts receivable method. The existing credit balance in allowance for doubtful accounts is subtracted from the desired balance to get the amount for the bad debts expense adjusting entry. Part 2. If the existing balance in allowance for doubtful accounts has a debit balance before the adjusting entry, the debit balance is added to the desired balance to get the amount for the bad debts expense adjusting entry. A debit balance in the allowance account results when specific write-offs for the year are larger than the balance provided at the beginning of the year. Part 1. The receivables turnover ratio tells us the number of times per year a company can convert its accounts receivable into cash. For any company, the higher the turnover, the faster the cash collection on accounts receivable. We calculate receivables turnover by dividing net credit sales by average net receivables. Part 2. Deckers reported 2006 net sales of $304,423,000. December 31, 2005, receivables were $39,683,000, and December 31, 2006, receivables were $49,571,000. Let's calculate the receivables turnover ratio. Part 3. Average net trade receivables is determined by adding the $39,683,000 beginning balance to the $49,571,000 ending balance and dividing the total by 2. The result is divided into the net credit sales revenue for the year to obtain a receivables turnover ratio of 6.8 times. Part 4. Deckers has a lower receivables turnover than Skechers and Timberland. When there is a decrease in accounts receivable for the year, cash collections from customers are more than sales revenue. Using the indirect method of preparing the cash flow from operating activities portion of the statement of cash flows, we add the decrease in accounts receivable to reported net income. When there is an increase in accounts receivable for the year, cash collections from customers are less than sales revenue. Using the indirect method of preparing the cash flow from operating activities portion of the statement of cash flows, we subtract an increase in accounts receivable from reported net income. Cash includes currency, coins, and amounts on deposit in bank accounts, checking accounts, and savings accounts. Cash equivalents are short-term, highly liquid investments that are easily converted into a known amount of cash, are close to maturity, and are not sensitive to interest rate changes. Cash and cash equivalents are usually combined on the balance sheet. Part 1. An internal control system is a collection of policies and procedures that safeguards assets, ensures reliable accounting, promotes efficient operations, and urges adherence to company policies. Specifically, internal controls should assist companies in maintaining adequate accounting information, ensuring that all transactions are legitimate and properly authorized, and detect or prevent the unauthorized use of company assets. Of all assets, cash is the most susceptible to theft and fraud. For that reason, effective cash controls are essential. Part 2. Separation of duties is one internal control practice that companies use to protect cash. The person handling cash should not be responsible for recording cash transactions. All disbursements should be duly authorized. In addition to separation of duties, internal controls for cash include promptly reconciling bank statements, proper authorization for purchases, proper authorization for cash payments, making all payments using pre-numbered checks, allowing only a limited number of persons authorized to sign checks, requiring daily deposits of cash receipts. Part 1. All businesses should prepare a bank reconciliation each month. The bank reconciliation should not be prepared by the same person who handles cash or accounts for cash transactions. A bank reconciliation explains the difference between the cash balance in the general ledger account and the amount shown on the bank statement. A bank reconciliation will identify any errors that need to be corrected by the company or the bank. Why are the balances different on the bank statement and on the cash ledger? Because of timing differences. Part 2. When we prepare a bank reconciliation, there are two sections. In one section, we reconcile the bank statement balance to the correct balance. In the other section, we reconcile the book balance to the correct balance. The correct balances in both sections should be equal. On the bank side, we will start with the balance on the bank statement and adjust it for outstanding checks, deposits in transit, and errors made by the bank. On the book side, we will start with the cash balance in the ledger and adjust it for collections made by the bank on our behalf, interest earned, bank service charges, customer checks that were drawn on accounts that were non-sufficient, and errors we made. Examples of collections made by the bank on our behalf are when the bank acts as a collection box for customer payments, or when the bank collects a note receivable for us from a customer. All reconciling items on the book side require an adjusting entry to the cash account. Now, let's look at an example of a bank reconciliation. Let's prepare a bank reconciliation for the Simmons Company. The July 31st bank statement indicated a cash balance of $9,610, while the cash ledger account on that date shows a balance of $7,430. Additional information necessary for the reconciliation is shown on the next page. Before preparing the reconciliation, we need the following information. Outstanding checks totaled $2,417. A $500 check mailed to the bank for deposit had not reached the bank at the statement date. The bank returned a customer's non-sufficient funds check for $225 received as payment of an account receivable. The bank statement showed $30 interest earned on the bank balance for the month of July. Check 781 for supplies cleared the bank for $268, but was erroneously recorded in our books as $240. A $486 deposit by Acme Company was erroneously credited to our account by the bank. Before advancing to the next slide, you should decide how each of these items affects the book or bank balance. We begin the reconciliation process with the bank balance of $9,610. Next, we add the $500 deposit in transit. Now we have two deductions: the $486 bank error and the $2,417 of outstanding checks. We now have determined that the correct cash balance is $7,207. This is the amount of cash that must be shown on the company's balance sheet at July 31st. We complete the reconciliation by adjusting the balance in our general ledger account. Simmons earned $30 in interest on the checking account during the month of July, so we must add this amount to the book balance. A check was written for $268, but erroneously recorded on our books as $240. We correct this error in the reconciliation by subtracting the difference, $28, from our book balance. Finally, we accepted a check and deposited it in the bank, but the check bounced because the maker did not have sufficient funds to cover the check. To correct this, we subtract the amount of the check, $225, from our general ledger cash balance. Notice that the correct balance on the bank and book sides of the reconciliation are the same. Our goal now is to adjust our book balance to the correct amount of $7,207. To do this, we will need to make two adjusting entries. Let's go to the next screen and begin making the adjustments. To record the interest earned on our checking account, we debit the cash account and credit interest revenue for $30. To correct the bookkeeping error, we will debit supplies inventory for $28. The non-sufficient funds check must be placed in an accounts receivable account because the person still owes us the $225. We will credit the cash account for the total of $253. Now, the reconciliation process is complete. Part 1. Credit card discounts, sales discounts, and sales returns and allowances are contra revenue accounts deducted from sales revenue in the income statement to arrive at net sales. Let's look at some examples to see how we record these contra revenue accounts. On January 2nd, credit card sales at a Decker's factory store were $3,000. The credit card company charges a 3% service fee. Prepare the Decker's journal entry. Part 2. The credit card service fee is 3% of $3,000, or $90. We record the credit card sales transaction with a debit to accounts receivable for $2,910, a debit to credit card discounts for $90, and a credit to sales revenue for $3,000. When preparing the income statement, we deduct the debit balance in the contra revenue account, credit card discounts, from the credit balance in the sales revenue account. Now, let's consider an example dealing with sales discounts. Part 1. On January 6th, Decker's sold $1,000 of merchandise on credit with terms of $210 net $30. Let's prepare the Decker's journal entry. Part 2. We record the sale with a debit to accounts receivable and a credit to sales revenue for $1,000. In the next example, we will assume that the customer paid within the discount period. Part 1. On January 14th, Decker's receives the appropriate payment from the customer for the January 6th sale. Let's prepare the Decker's journal entry. Part 2. The sales discount is 2% of $1,000, or $20. We record the cash receipt from the customer with a debit to cash for $980, a debit to sales discounts for $20, and a credit to accounts receivable for $1,000. When preparing the income statement, we deduct the debit balance in the contra revenue account sales discounts from the credit balance in the sales revenue account. Next, let's assume the customer paid after the 10-day discount period. Part 1. If the customer remits the appropriate amount on January 20th instead of January 14th, what entry would Deckers make? Part 2. Since the customer paid outside of the discount period, a sales discount is not granted. The customer forfeits the available $20 discount and remits the entire $1,000. We record the cash receipt from the customer with a debit to cash and a credit to accounts receivable for $1,000. Part 1. On July 8th, before paying, a customer returns $500 of sandals originally purchased on account from Deckers. The sandals originally cost Deckers $300. Let's prepare the Deckers journal entry. Part 2. Similar to a sales entry, a return of merchandise requires two entries, one at retail and one at cost. The retail entry includes a debit to sales returns and allowances and a credit to accounts receivable for the sales price of $500. The cost entry includes a debit to merchandise inventory and a credit to cost of goods sold for $300, the cost of the returned inventory. This entry is a straight reversal of the cost entry that is made when the sale occurred. End of Chapter 6.